Welcome to Breaking News to Trading Moves. Think about this scenario for a moment. If you were buying a house and you agreed on a purchase price, but right before you signed the final paperwork, the seller offered you the exact same property for 20% less, you would be absolutely thrilled.
Oh, without a doubt. I mean, that is a clear discount on a known physical asset.
Right. You would take the deal immediately. But when we step into the equity markets, that logic, it completely flips for most people. A stock drops by 20%, and instead of seeing a discount on a business, the broader market just panics. People rush for the exits.
Well, that is because a house is a physical structure you can actually live in. If that house suddenly drops in price because, an inspector found the foundation is sinking into the earth, buying the empty lot next door just because it is cheaper isn't a bargain.
No, of course not.
It is a compounding disaster.
And that perfectly sets up the practice we are debating today, which is averaging down. This is the strategy of purchasing additional shares of an asset as its price declines, with the explicit goal of lowering your overall average cost basis.
Right. The core question we have to resolve is whether averaging down is a rational strategy that allows contrarian investors to capitalize on market overreactions,
Which it often is.
or if it is a dangerous behavioral trap that encourages, throwing good money after bad.
So, we're going to connect the dots using decades of historical market data, behavioral finance observations, and institutional contrarian philosophies to explore this. I will be arguing that averaging down is a mathematically sound scaling mechanism, absolutely essential for capturing outsized returns during cyclical recoveries.
And I will argue that historical data proves this strategy is overwhelmingly a risk-blind behavioral error that actively destroys capital.
Let me start by laying out why averaging down is a necessary tool for any serious contrarian investor. Financial markets are deeply emotional. They frequently overreact to bad news.
I don't think anyone would dispute the emotion part.
Right. We see algorithmic selling, margin calls forcing people to liquidate their portfolios, and just general institutional panic that punishes companies far beyond what their actual intrinsic value dictates.
Sure.
When these forced liquidations happen, the price of an asset becomes completely divorced from the actual cash the business is generating.
I agree that markets overreact, but assuming every price drop is an overreaction is where investors get into trouble.
But by systematically scaling into a position as the price drops, an investor lowers their break-even point. Think about the pure arithmetic of it.
Okay, lay out the math.
If you buy an asset at $100, it drops to $80, and you purchase an equal amount at $80, your average cost becomes $90.
The arithmetic checks out. I won't dispute basic addition and division.
Exactly. And when the inevitable recovery occurs, you achieve profitability long before the asset ever reaches its prior peak of $100. True value creation requires a psychological fortitude to look wrong in the short term. You have to maintain equanimity during periods of market distress to capture the upside. It is entirely about buying fear when others are forced to sell.
See, I come at it from a completely different direction. That optimism about the math is often just a symptom of an investor's inability to admit a mistake.
How so?
There is a phrase that circulates among retail traders that captures this perfectly. I was wrong, might as well be more wrong. We have to look at the stark reality of historical base rates.
By base rates, you mean the historical probability of these events occurring across the broader market?
Exactly. We cannot just look at the exceptions. We have to look at the entire data set. When you analyze over 6,500 companies from 1985 to 2024, the median maximum drawdown,
The largest drop from peak to trough.
right, the maximum drawdown is a staggering 85%. Furthermore, 28% of those stocks suffer drawdowns of 95 to 100%. They essentially go to zero.
Those are very broad statistics, though. You are looking at the entire universe of stocks, including highly speculative microcaps that, frankly, perhaps shouldn't have been public in the first place.
Well, I am looking at the actual risk of ruin. Allocating more capital to an asset in free fall ignores the asymmetric risk of total loss. Nearly 60% of public companies since 1926 failed to match the returns of one-month Treasury bills.
Wow, 60%.
Yeah, that destroyed $10.1 trillion in value over time. Averaging down into that 60% is a highly reliable way to wipe out a portfolio entirely.
I see why you emphasize those numbers, but let's connect the dots on how portfolio recovery actually works when you look at the extremes.
Okay. The reason markets overreact to the downside is largely mechanical. A hedge fund blows up, they have to sell everything on their books, regardless of the underlying value of those businesses.
Right, a fire sale.
Exactly. That creates a pronounced V pattern in the worst-performing quintile of stocks. We see a sharp decline to the bottom, followed by a remarkably strong price recovery once the forced selling stops.
A recovery, yes, but often nowhere near the original previous all-time high.
But it does not have to reach the previous all-time high if you have been averaging down. That is the beauty of the mechanism. Let's simplify the math for anyone listening.
Go ahead.
If a $100 stock drops 80%, it is trading at $20. If you step in and buy more shares there, and the stock just bounces back to $50,
Which is still 50% below its old high. Right, exactly. But you have more than doubled your money on that second batch of shares. The math of cost basis reduction means you do not need the stock to hit a new record to generate a large market-beating return. You just need a median reversion, a slight return to normalcy.
I am not convinced by that line of reasoning because you are relying on averages and medians that mask a brutal underlying reality.
What reality?
Yes, the average returns of a loser portfolio might appear mathematically impressive after a steep drop, but the median returns of the actual individual stocks inside that portfolio are substantially worse.
Why would the median be worse if the portfolio is recovering?
Because a tiny handful of extreme outliers pull the entire average up. You might have one single stock that goes up 10 times in value, while the other 9 go literally to zero.
But that is exactly why you manage risk across the portfolio. You don't just put your entire net worth into one single declining stock.
Even within a portfolio, the base rates are punishing. The majority of companies with 80% drawdowns never return to their initial levels. We see this play out constantly. Take the very common, real-world experience of retail investors.
Like who?
Let's use Luminar, a leading nightclub operator back in the early 2000s. The stock drops from its peak, so an investor buys more. It drops again, they average down again.
And they keep lowering their cost basis.
They keep lowering it right until the stock goes completely to zero. You can have the lowest cost basis in the world, but if the final price of the asset is zero, your total return is still negative 100%.
Example actually proves my point about application.
How so?
Averaging down is a specialized tool. And like any tool, it has to be applied to the right material. This strategy is highly effective when applied to cyclical industries. It is disastrous when applied to secular declines.
Okay, that is very easy to say in hindsight. But how do you actually spot that difference in the moment when the market is crashing?
Let's look at the semiconductor industry, specifically NVIDIA, during the early 2000s dot-com bust.
Okay, NVIDIA.
The stock dropped roughly 90%. For anyone holding from the top, looking at their screen in 2002, that looked like an absolute catastrophe. The headlines were universally negative.
I'm sure they were.
But the semiconductor industry was merely facing cyclical overcapacity, meaning the underlying demand for computing power was not vanishing. The industry had just built too much supply too quickly.
Which caused prices for chips to plummet.
Exactly. But because it was a cyclical issue, a temporary glut that would eventually clear out, the stock recovered within 5 years and went on to deliver historic returns. Averaging down is the optimal way to play these predictable industry cycles.
You use the panic to accumulate shares.
Right, you use the market's temporary panic to accumulate shares of a distressed but structurally sound business.
That is a compelling narrative, but have you considered the survivorship bias in using NVIDIA as your example? We all know NVIDIA won.
Well, sure, but
We know they went on to dominate graphics and artificial intelligence. Identifying a cyclical trough in real time is nearly impossible even for institutional professionals with teams of analysts.
let me offer a counterexample with the exact same magnitude of drawdown.
Okay, what is it?
Foot Locker.
The shoe retailer?
Correct. Foot Locker experienced a 90% drawdown starting in 1990. On paper, it looked just like NVIDIA, a large drop, seemingly a market overreaction to some bad earnings quarters.
But they were in retail, completely different dynamics.
Right. Unlike NVIDIA, Foot Locker was not facing a temporary cyclical dip. It was in a secular decline, meaning the actual structural way the world bought shoes was changing, and they were on the wrong side of history.
Right, broader big box retailers like Walmart were taking their market share. Exactly. And eventually e-commerce would start eating into it as well. Do you know how long it took Foot Locker to recover?
I know it was a long road for shareholders.
Over 22 years. It took until late 2012 to return to its previous highs. Most investors do not have a two-decade time horizon.
No, they don't.
If you average down on Foot Locker in 1991, 1992, and 1993, you tied up your capital in a dead asset for an entire generation. That brings in the critical concept of opportunity cost.
Of course.
If your money is stuck in Foot Locker for 22 years just waiting to break even, you miss the greatest bull market in history happening everywhere else. That is the danger. You think you are buying a cyclical dip, but you are actually catching a falling knife in a dying business model.
Which is exactly why the qualitative assessment of the business is so critical. You have to ask, is the basic economic engine of the company still intact? Are they still generating free cash flow?
Those are hard questions to answer when there's blood in the streets.
They are. But you have to look at whether they have debt covenants that might force them into bankruptcy before the cycle turns. Are they maintaining their market share despite the stock price dropping? If you can verify those underlying metrics, the price drop is an opportunity, not a death sentence.
But you are assuming investors are emotionless calculators who sit down and calmly read debt covenants while their net worth is evaporating in front of their eyes?
The reason those historical base rates look so bad is precisely because people panic. If you are listening to this right now and you are currently down 40% on a stock you bought last year, your stomach is probably in knots.
Oh, absolutely.
The entire financial media, your peers, and your own internal doubts are screaming at you that you are wrong. Taking a non-consensus view is socially and spiritually uncomfortable.
It is uncomfortable because you are losing actual money.
But as the strategists at Burgundy Asset Management point out, being disagreeable is non-negotiable if you want to withstand that inherent social pressure. By having a strict mechanical rule to average down, investors actually bypass the panic.
How do they bypass it?
They force themselves to do what is rationally required, buying when assets are genuinely cheap. Think about how a corporation buys a business. If a large conglomerate wants to acquire a smaller company, they buy it in tranches over time.
Right.
No rational corporate buyer demands to pay the highest possible price for their entire stake all at once on day one. They scale in. Retail investors should view their positions the exact same way. You are building a position in a business, tranche by tranche, at increasingly attractive valuations.
I am sorry, but I just don't buy that corporate analogy. A corporation buys tranches based on a rigorously verified inside look at the target's cash flows, customer contracts, and balance sheet.
Which individuals can approximate with public filing.
They don't have teams of forensic accountants, though. Retail investors, and honestly a lot of professional active managers, often average down out of pure pride. They anchor to the initial purchase price.
Anchoring is a real behavioral bias. I fully agree.
It is the defining bias in this entire debate. They buy at $100. The stock drops to $80. Instead of asking, is this company actually worth $80 today based on the new information we have? They ask, how can I get my average cost down so I don't look foolish to my spouse or my clients?
Well,
There's a classic rule in risk management, the Zurich axiom. When the ship starts to sink, don't pray, jump.
But extreme volatility does not equal a sinking ship.
Sometimes it does. Look at the retail traders who bought Fannie Mae on the way down during the global financial crisis.
Fannie Mae.
The stock dropped to 80 cents. They bought. It fell over the course of a year to 34 cents. They kept buying, convinced they were practicing contrarian brilliance by lowering their average cost.
That was a uniquely terrible macro environment.
But they were not corporate acquirers buying tranches of value. They were compounding their losses in an asset that was structurally failing under the weight of toxic mortgages.
The math of averaging down only works if the stock eventually goes back up. If it doesn't, averaging down just accelerates the destruction of your wealth.
I concede that point entirely. Doing this blindly is a peril, but you cannot throw out a proven scaling strategy just because some investors apply it to failing companies. Let's look at the broader application.
okay. If we accept that picking the exact bottom, buying at the absolute point of maximum drawdown,
is impossible. Even legends like Bernard Baruch admitted that. Then what is the alternative?
Finding better assets, maybe.
If you love an asset at 100 and nothing structurally has changed about the business model or the management team, you must logically love it more at 60.
That assumes your initial assessment at 100 was flawless, and human beings are fallible. The facts might have changed, but you are too stubborn to see it.
It assumes you are acting as both a hedgehog and a fox, to borrow another concept from Burgundy.
Go on.
You are a fox in that you can discern the quality of the business, adapting to new data and nuance. And you're a hedgehog in that you have a strong, singular sense of direction, pointing toward long-term intrinsic value. When you combine those and you hit rough weather, averaging down is how you preserve and eventually grow capital. In theory, you lower your break-even point so that when the market finally recognizes the intrinsic value you saw all along, your yield on cost is maximized, meaning the annual dividend or earning power relative to the average price you actually paid.
That is the ideal scenario. But the data tells us the ideal scenario is the exception, not the rule. Think back to the Bess-Binder study on lifetime stock returns.
Right.
Out of 28,600 companies over decades, a mere 2% of them accounted for the entire net wealth created in the stock market. 2%.
It's a small number.
When you average down on a random individual stock, the statistical probability is that you are pouring capital into the 98% that will ultimately underperform Treasury bills.
Which is exactly why averaging down is arguably best applied to broad market indices or heavily diversified portfolios rather than single speculative tech stocks.
Oh, wait, hold on. If the S&P 500 draws down 50%, as it did during the global financial crisis, averaging down into the index is historically a guaranteed path to wealth creation. The broader economy has always recovered.
You cannot use the index to defend the practice of averaging down on individual stocks. On an index level, the math is entirely different because the index automatically cleans itself.
That is a fair distinction. Standard & Poor's kicks out the bankruptcies and failing companies and replaces them with growing, dominant companies. You are benefiting from survivorship bias built right into the index rules.
Right.
But we are talking about the strategy as it is commonly used by investors picking individual equities. And in that arena, the base rates of corporate distress make it a highly dangerous game. The portfolio with the worst total shareholder returns generally goes down earlier, falls deeper, and takes drastically longer to recover, if it ever does at all.
Let's bring this together and look at where we stand after exploring both sides. From my perspective, averaging down remains a highly potent mechanical tool. It reduces your cost basis and positions you to capture outsized yields during a market recovery. However, it requires ironclad discipline. You have to restrict the strategy to broad market indices or to cyclical industries where a long-term recovery is mathematically probable and the balance sheet is structurally sound enough to survive the winter.
And my summary is that while the arithmetic of cost basis reduction is technically accurate, the overwhelming historical base rates of corporate distress cannot be ignored. For individual equities, averaging down is a perilous endeavor.
It certainly can be.
The market frequently punishes investors for their blind loyalty to declining assets, trapping capital for decades in dead businesses and carrying a heavy opportunity cost.
But I think we have found a clear point of convergence here. We both agree that employing this strategy blindly just because a price is lower than it used to be is a recipe for capital destruction.
Absolutely.
If an investor averages down without an incredibly rigorous assessment of whether a price drop is a temporary cyclical dip or a permanent secular decline, they are just gambling.
Exactly. The difference between catching a falling knife and buying a generational discount lies entirely in the objective appraisal of changing business realities. You cannot just look at the price ticker, you have to look at the economic engine underneath it.
Are the cash flows real? Is the market share holding up? Are the debt levels manageable?
Right.
It really highlights the value of considering multiple perspectives in market strategies. Navigating drawdowns requires balancing strict mechanical rules, like scaling into positions, with a harsh, objective willingness to admit when the initial thesis is completely broken.
Right. It is remarkably difficult to separate a sinking ship from a temporary storm when you are standing out in the rain. You cannot let the desire to lower your break-even point blind you to a crumbling foundation.
Which brings us right back to where we started. If you are buying a house at a 20% discount, it is only a good deal if the foundation is solid. If the structure is sinking, no discount in the world makes it a smart investment.
You have to know what you are buying, especially when it is on sale.
Does the falling price represent a true market overreaction, or is it the market efficiently pricing in a permanent collapse? There is plenty more to explore on this topic, but that is where we will leave the debate today.